Hello, welcome to the sixth module of public sector accounting class. And we'll be talking about accounting for government assets and liability today, accounting for government assets and liabilities. And we will briefly look into the classification and valuation of public assets, the depreciation and revaluation of assets. We'll look into the accounting for public debt and liabilities. And lastly, we'll look into reporting on infrastructure and heritage assets. This module focuses on how government accounts for what they own, which is the assets, and what they owe, which is the liabilities. And accurate accounting is very, very crucial for one, transparency and accountability, two, showing the true financial position of such a government, and three, effective management of public works, and four, ensuring fiscal sustainability. When we look at the valuation of public assets, what does government own? The classification of assets, what does the government own? The first that we'll look briefly at is the fixed or non-current assets. And when we talk about the fixed or non-current assets, these are long-term resources such as land, buildings, equipment, and more that are owned by the government. We also have infrastructure assets. These are large-scale systems, the road, bridge, water system that are owned by the government. We have the heritage assets. These are assets which include cultural or historical items like monuments, museums, and some others. They are assets of the government. We also have the financial assets. And when we talk about this, these are investments and loans that are given. And we have the current asset also. And these are the short-term resources such as cash, receivables, and some others. How do we put a value on this that we've stated? And that's why we talk about valuing public assets. How do we put value on them? We have a number of means of putting value on them. The first is historical cost. And this is the original purchase or construction cost. It's a cost that deals with the original purchase or construction cost. So it can be valued based on the original purchase or the construction cost. Another means of valuing or valuation is the replacement cost, using of replacement cost. And for these costs are being replaced with a new similar asset. That is, costs are used to replace, they are replaced with a new or similar assets. Also, we have another valuation method, which is fair value. And when we talk about this, it's the price in a current market transaction. If an asset can be valued using fair value, where the price is actually the current the price is stated as the current market transactions. And we have the revaluation model, which is the periodical or updating the value to reflect market condition. It's periodical, updating the value of such an asset periodically to meet the market conditions. We also will be looking into depreciation briefly. And when we talk about that, what is depreciation? It is the systematic allocation of an asset cost over its useful life. It is the allocation of an asset cost over its useful life. And why is it done that way? It is done to be able to match the cost of the asset with the services it provides each year. And it shows how much of the asset value has been used up. So if you buy a car, over the years, you use it for the first year, the second year, the value has been apportioned to be used up already. And when it gets to a particular time, it gets used up completely. So that is depreciation, a year in, year out valuing of or depreciation of assets. And one key method that is being used to depreciate an asset is a straight line method of depreciation. And to do this, it is cost of assets minus residual value. Cost of asset minus residual value divided by the useful life. For example, if a value is worth 10 million naira with a residual value of 1 million naira and a useful life of 5 years, then the annual depreciation will actually be that 10 million minus 1 million divided by 5 years. And that means a total amount of 1.8 million naira will be deducted per year. That shows the annual depreciation. It shows the annual amount that will be deducted or that will be depreciated from the cost of the asset itself. And revaluation, on the other hand, is the adjusting the book value of an asset to its current fair market value. And it is done because historical cost can become outdated. And revaluation ensures the balance sheet shows a realistic value. A method of doing that, the methods of doing this is one, indexation. And when we talk about indexation, this is a method of valuation where inflation is adjusted using a price index. And another one is the appraiser, which is a method of revaluation where an independent expert determines the value of such an asset. And the accounting impact of this is that it can lead to increase in value. Like increase in value, when we talk about increase in value, it's credited to a revenue revaluation reserve, which is equity. And when the impact comes as a decrease in value, when the revaluation comes as a decrease in value, rather, it's recognized as an expense, which is a loss. So if it comes as an increase in value, it is being credited to the revaluation reserve, which is equity. And when it decreases in value, it is being recognized as an expense, which is a loss. And accounting for public debt and liabilities. What does government own? We've talked about what government own. What does government owe? The first we'll be looking at is the public debt, and this is the total outstanding borrowings, and it can be domestic debt or external debt. When we talk about domestic debt, it's actually owned to lenders within the country, while external debts are owned to foreigners outside the countries. Example of this are World Bank and some others. And other liabilities is actually another government owing. And these are unpaid salaries, pensions, obligations, legal claims, and some others. We also have the contingent liabilities, which are potential obligations, that is, e.g., example is guarantees for state-owned enterprises. Why is accounting for debt crucial? It ensures fiscal discipline and debt sustainability. It provides transparency for citizens and investors, and it informs policy on borrowing limits and repayment. We also need to look at the accounting cycle for public debt, and for this, the authorization is the first process, the authorization, which talks about legislature approve the borrowings, and the second is receipt of loan. And when it is being received, you debit the cash of bank accounts and you credit the public debt, which is the liability account. For the another is the interest payments. When we talk about the interest payment, you debit the interest expense account and then you credit the cash or bank accounts. For principal repayment, you debit the public debt, which is the liability account, and you credit the cash or bank account. And in terms of reporting, it's actually detailed disclosure in financial statement as per the International Public Sector Accounting Standard 30. We also have the special assets, where we talk about the infrastructure and heritage assets. And for these infrastructure assets, just like we said, roads, bridge, power grids, and some other things, they are actually long-lived, high-cost essential for public services. They are long-lived assets, high-cost assets, and they are essential for public um, services, and in accounting for this, they are capitalized as assets and depreciated over their useful life. And for heritage assets, just like we said, the museum, monuments, historical sites, they are characterized by cultural values, indefinite life, and they are often non-monetary benefits. And the accounting challenge of this is that it's difficult to value. No active market for it, so it's difficult to actually value. And the solution that is being made available is it can be recognized at cost or fair value if measurable, often not depreciated, but checked for impairment, which is loss of value. And in reporting and disclosure, which is the IPSAS requirements, government must disclose comprehensive information about asset and liability. And for asset valuation basis must be used, that the cost or evaluation, then depreciation method and useful life, and then addition and disposal. These are very, very important to be disclosed. And for liabilities, total debt must be disclosed. The interest rates and repayment terms must be reported and disclosed. And then the details of contingency liability are also to be made known. The goal of this is to provide a complete, transparent picture of the government's stewardship. In conclusion, government raise money from tax and non-tax sources, and revenue are collected. We've looked at the various assets and liability accounts of government, and we've been able to see that this having the understanding of this will actually bring about transparency and accountability. When government assets are being made known and the liabilities are being made known to the public, they actually provide a basis for transparency and accountability, and also stewardship, and also ensuring fiscal sustainability, making sure that there is check and balance as to the debt that is supposed to be owed, and knowing the amount of assets that a government actually possess. Thank you for listening.